Timothy P. Vick, How to Pick Stocks Like Warren Buffett, Profiting from the Bargain Hunting Strategies of the World's Greatest Value Investor. Welcome to the captivating world of Warren Buffett, the man who built a $30 billion fortune through calculated investment strategies. Through a summary of Timothy P. Vick's book, How to Pick Stocks Like Warren Buffett, Profiting from the Bargain Hunting Strategies of the World's Greatest Value Investor, you'll discover Buffett's impressive journey and the principles he used to compound wealth. As you delve into this summary, you will explore the significance of mathematics in his investment decisions, the importance of financial leverage, and the power of compounding money over time. Learn from Buffett's strategies and the characteristics he seeks in choosing stocks or acquisitions.
The investment strategy of Warren Buffett. Warren Buffett's investment strategy revolves around exploiting the world's financial inefficiencies to accumulate wealth rapidly. Buffett adopts a different tactic from other money managers by investing in undervalued companies and taking a leading role in correcting their financial position, thus earning a board seat and assisting in the sale of the company for more than he paid. He compounded the profits earned from cash-generating firms at annual rates reaching 20% to 30% and used financial leverage to invest amounts well in excess of the company's capital base. His investment philosophy was influenced by Benjamin Graham's value investing principle, which involves buying undervalued securities based on a company's inner worth. Buffett's success is due to his ability to recognize the forces that link price to value and his approach to investing in stocks, which emphasizes the long-term growth potential of a company's sales over its earnings. Buffett's strategy. Learn how Warren Buffett transformed Berkshire Hathaway into the world's largest investment pool using his unique strategy. Warren Buffett, one of the world's most successful investors, began buying shares in Berkshire Hathaway in 1962, a textile mill located in Massachusetts. By 1967, he took control of the company and became its chairman in 1970. Through Berkshire Hathaway, Buffett acquired several other companies to expand his investments, eventually using the firm as the world's largest investment pool. His strategy involved taking advantage of the cash flow of existing businesses held by Berkshire Hathaway, cutting their costs as necessary, and using this increasing cash flow to buy other companies. He preferred to buy only cash-rich companies at cheap prices to realize a high return on the original investment. Buffett also added a portfolio of insurance companies to the mix as conduits for buying stocks and bonds and using these insurers to provide a low-cost float to increase available investment money. Buffett believed that diversification is the bane of high returns and that value-oriented investors, like himself, have no use for it. Instead, he focused on increasing Berkshire's book value, pushing up the value of its stock. By the end of 1999, Buffett had increased his own stake in Berkshire from 29% to 33.7%, making a profit of more than 40% of Berkshire's book value. Overall, Warren Buffett transformed Berkshire Hathaway into the world's largest investment pool, using his unique and successful strategy that has made him one of the most influential minds in investing. Buffett's investing criteria. Berkshire Hathaway's success is attributed to Buffett's simple investment criteria, seeking profitable businesses with stable management generating high cash flow, unique positioning in the market, and available at reasonable prices. Buffett believes the key to success is obtaining float at a low cost, a strategy that has served Berkshire Hathaway well. He emphasizes the importance of justifying an investment mathematically and waiting until the right combination of price and value is met. By adhering to these principles, Buffett has consistently boosted Berkshire Hathaway's book value and his own personal net worth. The power of compounding, a lesson from Buffett. Learn how Warren Buffett's approach to using mathematics to assess the financial feasibility of deals can help you maximize the power of compounding your money over time. By focusing on good companies at fair prices and avoiding overpriced stocks, investors can obtain returns far in excess of the market and increase their wealth over time. Buffett emphasizes the importance of paying attention to the value of an asset, based on its earnings, and ignoring Wall Street performance predictions and marketing scripts. In the long run, the price of any asset will find its intrinsic value, and the power of compounding will amplify returns and grow your net worth. Strategies for investing successfully. Investing your money wisely using a handful of time-tested techniques can lead to long-term financial growth and security. Here's what you need to know. Investing can be a daunting prospect, but if you're willing to do your homework, you can maximize your profits and minimize your risks with a few simple strategies. First, look for value and always buy low and sell high. Don't be tempted by high-priced stocks. Studies show that investing in undervalued stocks yields more gains over time. Keep your purchases concentrated rather than diversifying too much. The more stocks you own, the harder it is to keep track of which are the winners and which are the duds. Pay attention to expenses and commissions, and reinvest all your dividends to increase your returns. It's also crucial to evaluate your spending habits and unnecessary personal expenses, as every dollar spent now is potentially many dollars lost later. And finally, the key to any successful investment strategy is a buy-and-hold approach. Frequent trading or relying too heavily on complex market forecasts or stock-picking systems can lead to costly mistakes. Instead, take your cues from Warren Buffett and identify the stocks you want to own, buying only when they become attractively priced. With these techniques in your toolbox, you can invest with confidence and set yourself on the path to long-term financial growth and security. The Buffett Way. Learn how to analyze companies like Warren Buffett by placing primary focus on their net income and yearly growth rate, alongside their capacity to convert sales to earnings. The book espouses traditional valuation methods and provides useful yardsticks on worth estimation such as book value. To minimize risks and avoid losses, it is advisable to avoid rapid trading and use past growth records and market conditions to predict future earnings. Aim at purchasing stocks that can return at least 15% annually. Warren Buffett is one of the most successful investors globally, but what makes his investment approach so successful? The book, The Buffett Way, explores how Warren Buffett analyzes companies to determine their worth and whether or not to invest in them. The book emphasizes the importance of focusing on the annual net income of a business, rather than just the share value, and viewing the market price only as a point of reference to determine the business's value, whether it's undervalued, correctly valued, or overvalued. The book outlines specific methods for estimating a company's value and potential worth. The author stresses how essential it is to judge a company by how effectively it can convert sales to earnings and the annual rate at which earnings increase. Moreover, the book suggests using the traditional yardstick of book value, since a company's book value increases as its intrinsic value and share price increase over time. By examining a company's book value, one can comprehensively analyze the growth of its performance. A significant theme throughout the book is the importance of minimizing risk while investing. Buffett avoids risky or unpredictable investments. Rather, he advocates purchasing low-risk long-term stocks that can return at least 15% annually through growth in per-share book value. To maximize long-term returns, the author, Warren Buffett, emphasizes the need to be patient and avoid rapid trading. In conclusion, The Buffett Way is an insightful read, with practical methods for keeping losses to a minimum and maximizing long-term profits. By focusing on traditional valuation methods, determining a company's annual net income, conversion rate, future earnings, and growth rate, it's easier to assess a company's worth and investment potential. By embracing a long-term view that minimizes risks and maximizes returns, investors can aspire to enjoy staggering long-term results.
Having explored Buffett's investment philosophy, you now understand that the secret to his success lies in his use of mathematics, focusing on intrinsic value, and the power of compounding. But his approach also involves ignoring Wall Street predictions, avoiding diversification, and minimizing expenses. By buying businesses based on their cash flow, those with simple models and stable management, he consistently maximizes his fortune. Remember the correlation between book value, share price, and intrinsic value, as well as the 15% rule to assess potential investments. Ultimately, it's about finding those undervalued gems and letting them grow over time, as Buffett did. consistently and patiently building a remarkable legacy.